Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, and I've returned today to whap and tap on your head with the right questions, knowing what to ask. Today, we're going to go into some insurance topics, but before I go in, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So, I was talking to somebody about life insurance the other day, and he was like, yeah, but what if they get the lump sum of money and blow through it? So, there's something called a spendthrift clause. What is a spendthrift clause? So a spendthrift clause, let's put in life insurance. So the spendthrift clause gives the insurer the right to hold back the proceeds and protect the funds from. So in a trust, right, spendthrift life insurance policies pay out benefits over a given period. For example, 5 years on a regular basis, as opposed to a singular lump sum. What is a spendthrift trust? A spendthrift trust is a type of trust that regulates a beneficiary's access to the funds or assets held within the trust account. So, why would you do this? Well, you would do this instead of trying to spend money that you don't have, coming with very specific rules in your trust funds, right? Let's see, what is an example of a spendthrift clause? For example, let's say you have an estate worth $2 million. Instead of getting the estate in its entirety at once, a spendthrift provision could arrange to disperse any dividends earned on a quarterly basis. As the grantor or the person who created the trust, you must appoint a trustee. So, again, like I said, generational wealth. If the average annual income is $50,000, you get a $10 million life insurance policy. When that person dies, you take that $10 million, you put it in a money market account. 0.5% of $10 million is $50,000. This way, your family lives off of $50,000 for eternity. What is a spendthrift clause in a life insurance policy? From Quizlet. The spendthrift clause in a life insurance policy is designed to protect beneficiaries from their creditors by providing that the death benefits payable are not subject to creditor claims. This clause applies only while the insurer holds the money and only to installment payments. Let's see, what are the disadvantages of a spendthrift trust? So the pros of a spendthrift trust are that it can prevent creditors and lawsuits from attaching to the beneficiary's assets and provide a steady income stream. The downside is that it can be expensive to set up and maintain, and the beneficiary may be able to challenge the trust's spendthrift provisions in court. But that's going to be it for today. Let's see. What are the exceptions to the spendthrift clause? Breakthrough creditors. Government debts. The first exception is for the government, both federal and state, in order to settle debts to the government, such as unpaid taxes. The second is spousal support. A spouse or likely an ex-spouse is seeking spousal support. So that's going to be it for today, ladies and gentlemen. That's a little bit about the spendthrift clause. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. With that being said, ladies and gentlemen, wipe ass, work in progress every day and see success. And remember, folks, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.